our view might be that there is certainly some anomaly that you see in minimum variance portfolios. We agree the historical data does show that. However, a lot of it is about return geometry, the fact that when you lose 50%, you need to make 100% to get back to the money you started with. So I guess I have two questions. First of all, does the research stand up using arithmetic average returns rather than compound returns? I.e., if portfolio managers rebalance frequently to overcome the geometry effect, does it still work? Or are you effectively arguing buy and hold? And I guess, second of all, you say that beta is a negative predictor. I'd perhaps argue that there's more than just one beta. And actually, once you start to move to a multi-factor model, a multi-factor framework, what you're actually seeing is other betas drowning the effect of the main market beta. You call it small cap beta, value beta, almost, if you like, define a quality beta, a low risk beta. Effectively, that not the model itself doesn't work, but simply that our model isn't detailed enough when looking at one factor.
I think your question is an excellent one. In terms of arithmetic mean return versus geometric mean return, that was initially brought up as an important indication by Michael Jensen in his PhD dissertation around 1968, published in the early 1970s. And that has to do with a concept called volatility drain. If you have two portfolios that have exactly the same expected return, but one has higher volatility than the other, and you look at multiple periods of time into the future, over multiple periods of time, they have the same expected return over multiple periods, but the distribution for the high volatility portfolio gets skewed in the sense that the expected return becomes increasingly dominated by very high returns that are very unlikely. So if you look at the median average return on a high volatility portfolio vis-a-vis a low volatility portfolio, the median average for the low volatility portfolio begins climbing relative to the median average for the high volatility portfolio. And this is one possible explanation as to why we see low volatility portfolios outperforming, but only one. And as we go along, I'll try to throw in what I think is the real reason. But that's certainly a possibility. Now, in terms of multiple betas, I have a paper that I recently wrote called Case Closed. If anybody wants to read it, you can Google Haugen Case Closed and download it for free. And what we show in that paper is essentially what we showed in our Journal of Financial Economics 1996 paper, that high expected return portfolios have a very interesting characteristic. They tend to be relatively large companies, low risk in terms of all the measures of market risk, but then going beyond market risk and looking at fundamentals, they tend to be profitable companies now. They tend to be on the uptrend in terms of their profitability, good and getting better. They tend to be selling at cheap prices. They tend to have positive momentum. So in terms of their aggregate characteristics all around, they look spectacular. They look absolutely spectacular in terms of everything. And then if you go to the other end of the spectrum and look at the stocks with low expected return, they look the exact opposite. They're really scary looking companies. Profitability low and getting worse. They're relatively illiquid companies. They have high volatility. They're truly scary.
What's defining your expected return in that context?
What we did is we used the expected return factor model that we originally published in the JFE paper, and we formed into deciles every month, and this goes from 1963 to 2007. Decile 10 had the highest expected return every single month based on the expected return model. Decile 1 had the lowest expected return every single month. And then we looked at the characteristics of the Decile 10 portfolios vis-a-vis the Decile 1. And there was an amazing, it was just monotonic all the way in terms of all these characteristics. You go from really scary to really attractive. And if you were to just use your intuition and say, well, which would I expect to have high returns and which would I expect to have low returns? Well, Decile 1 you'd expect to have the lowest returns, and it does. And Decile 10 you'd expect to have the highest returns, and it does. And this is totally inconsistent with all the tenets of modern finance, which would say that the scary portfolio should have the highest expected returns because investors are risk averse, and the attractive portfolio should have lowest expected returns because they're the most attractive and most comfortable to invest in, but it turns out to be the opposite.